debt, not always a four-letter word. Many people view debt as a negative thing. It's often associated with financial stress and difficulty. However, the wealthy understand that debt can be a powerful tool for building wealth. The key is to use debt strategically, leveraging it to create opportunities and maximize returns. Think of it like this: debt is like a sharp knife. In the wrong hands, it can be dangerous, but in the hands of a skilled chef, it becomes an instrument for creating culinary masterpieces. The rich don't fear debt, they embrace it. They understand that by using other people's money wisely, they can amplify their own gains and accelerate their path to financial freedom. This essay will explore the various ways the wealthy utilize debt to their advantage, turning what many perceive as a liability into a powerful asset. One common way businesses use debt is through trade-based borrowing. This method is particularly popular among companies that deal with physical goods, as it allows them to manage cash flow more effectively. This involves taking out a loan to finance the purchase of goods or services, which can be crucial for businesses looking to expand their inventory or enter new markets. The primary goal is to sell those goods or services at a profit, thereby not only covering the loan but also generating additional revenue. For example, imagine a furniture importer who identifies a popular new line of chairs manufactured overseas. Recognizing the potential demand, they decide to act quickly. They secure a loan to purchase a large shipment of these chairs, ensuring they have enough stock to meet anticipated customer demand. Once the chairs arrive, they sell them at a markup, repaying the loan with the proceeds and pocketing the profit. This cycle can be repeated to continually grow the business. This strategy allows businesses to leverage debt to increase their purchasing power and generate revenue. It's a calculated risk that, when managed well, can lead to significant growth. By using borrowed funds, they can access larger inventories and capitalize on market opportunities that might otherwise be out of reach. This can be especially beneficial in competitive markets. Trade-based borrowing is a fundamental concept in business and a prime example of how debt can be used to fuel growth and profitability. It underscores the importance of strategic financial planning and market insight. Real estate is another arena where the wealthy skillfully utilize debt. One strategy involves refinancing existing mortgages to access lower interest rates or tap into home equity. Imagine a homeowner who purchased a property several years ago. As property values rise, so does their home equity. They can refinance their mortgage to secure a lower interest rate, reducing their monthly payments and saving money over the long term. Additionally, they can withdraw a portion of their home equity through a cash-out refinance. These funds can be used for various purposes, such as investing in other assets, funding a business venture, or making home improvements. The tax code also offers advantages to real estate investors. Mortgage interest payments and property taxes are often deductible, reducing their overall tax burden. This further enhances the appeal of using debt strategically in real estate. The strategies discussed so far highlight a crucial concept: leverage. Leverage is the use of borrowed funds to amplify potential returns. It's like using a lever to lift a heavy object. A small amount of force can move a much larger weight. In the world of finance, leverage can magnify gains. However, it's essential to remember that leverage is a double-edged sword. Just as it can amplify profits, it can also magnify losses. If an investment made with borrowed funds declines in value, the losses are amplified by the leverage used. This is why it's crucial to approach leverage with caution, carefully assessing the risks involved. The wealthy understand the power of leverage, but also recognize its potential downsides. They use it judiciously, balancing potential rewards with their risk tolerance. Section 5. Hedge funds. High stakes, higher rewards. Hedge funds are investment funds that cater to high-net-worth individuals and institutions. They often employ aggressive investment strategies, including the use of leverage and short selling, to generate high returns. Short selling involves borrowing shares of a stock and immediately selling them in the market. The hope is that the stock price will go down. If it does, The short seller can buy back the shares at a lower price, return them to the lender, and pocket the difference as profit. However, if the stock price goes up instead of down, the short seller incurs a loss, which can be substantial if the price rises significantly. Hedge funds often engage in complex financial transactions and use sophisticated investment strategies. While they can generate significant returns, they also carry a high degree of risk. Section 6. Short selling betting against the market. Short selling, as mentioned earlier, is a strategy used by some investors, including hedge funds, to potentially profit from a decline in a security's price. This method is often employed when investors believe that a particular stock is overvalued and due for a correction. It's essentially a bet against the market. Investors are wagering that the stock price will drop, allowing them to buy it back at a lower price. Here's how it works. An investor borrows shares of a stock they believe is overvalued and due for a price drop. These shares are typically borrowed from a brokerage firm. They immediately sell these borrowed shares in the open market, hoping to buy them back later at a lower price. The goal is to capitalize on the anticipated decline in the stock's value. If their prediction is correct and the stock price falls, they can repurchase the shares at a discount, return them to the lender, and keep the difference as profit. This difference is known as the short seller's gain. However, short selling is incredibly risky. The market can be unpredictable, and even well-researched bets can go wrong. If the stock price rises instead of falling, the investor will need to buy back the shares at a higher price, leading to a loss. This scenario can be financially devastating. And since stock prices theoretically have no limit on how high they can go, potential losses in short selling are unlimited. This makes short selling a high-stakes strategy that requires careful consideration and risk management. Section 7. Forex currency speculation and its risks. The foreign exchange market, or Forex, is the largest and most liquid financial market in the world. It operates 24 hours a day, 5 days a week, across major financial centers in different time zones. It involves the trading of currencies, with traders aiming to profit from fluctuations in exchange rates. These fluctuations can be influenced by a variety of factors, including interest rates, inflation, and political stability. For example, a trader might buy euros with US dollars if they believe the euro will strengthen against the dollar. This decision is often based on economic indicators or market trends. If their prediction is correct, they can later exchange their euros back into dollars at a more favorable rate, making a profit. However, this is easier said than done. While Forex trading can be lucrative, it's also highly speculative and carries significant risk. The market's volatility can lead to substantial losses just as quickly as it can lead to gains. Exchange rates are influenced by a multitude of factors, including economic data, geopolitical events, and market sentiment, making accurate predictions challenging. Traders must stay informed and be able to react quickly to market changes. Like short selling, Forex trading involves leverage, which can amplify both gains and losses. Leverage allows traders to control larger positions with a smaller amount of capital, but it also increases the potential for significant losses. It's crucial for traders to thoroughly understand the risks involved and implement appropriate risk management strategies. This includes setting stop-loss orders, diversifying their portfolio, and staying disciplined in their trading approach. Section 8. The power of reputation building borrowing power. A crucial aspect of using debt effectively is establishing a strong borrowing reputation. Lenders are more likely to approve loans and offer favorable terms to borrowers with a proven track record of responsible debt management. Building a strong borrowing reputation involves several key factors. Paying bills on time, consistently paying bills, and loan payments on time demonstrates financial responsibility. Maintaining a good credit score. A good credit score indicates creditworthiness and a low risk of default. Managing debt levels. Keeping debt levels manageable shows lenders that you're not overextended financially. By establishing a reputation for financial responsibility, Individuals and businesses can access larger loans at lower interest rates, giving them a significant advantage in pursuing wealth-building opportunities. Section 9. Mastering Debt, a Tool for Wealth Creation. As we've explored, debt is not inherently good or bad. It's a tool that can be used wisely or unwisely. The wealthy understand this distinction and have mastered the art of using debt strategically to their advantage. They leverage debt to finance business ventures, invest in real estate, and amplify potential returns. They understand the importance of a strong borrowing reputation and the need to manage risk carefully. While debt can be a powerful tool for wealth creation, it's essential to approach it with caution. Before taking on any debt, it's crucial to have a solid understanding of the risks involved and a plan for managing those risks effectively. Remember, debt is a tool. Like any tool, it can be used to build something great or to cause damage. The choice is yours.